Hi, I'm Pattu from freefincal. In today's video, I want to show you how to calculate the downside capture ratio for a mutual fund and what exactly this ratio signifies. If you're familiar with my mutual fund screener that I publish every month, you can go to freefincal.com and you see the fund screener right here. I have something called the downside protection consistency, and that's based on the downside capture. So this is, for example, the Morningstar page of HDFC equity fund, and if you go to the risk and rating tab, you have the several risk measures. I have talked about this in another video. If you want me to make a video on this, I will, but I just made a video on this in Tamil if you for those who know it. So over 3, 5 and 10 years, it gives you something known as the downside capture. And if you notice, over 3 years, the downside capture of this fund is 120%. That means it has lost 20% more than the benchmark, and the benchmark is written down here. This is BSE 500. And if you go to over 10-year periods, it has lost 9% more than its benchmark. So what is this exactly is this downside capture, and how is it calculated? So let's find out and how I use it for my screener. I have an old video on this, but I thought it's nice to do it again. So in order to understand upside capture and downside capture, we need to understand how to compute the annualized return from a set of monthly returns. So suppose I give you a set of monthly returns, that's 12 return data points, 2.07%, 2.03%, 3%, 0.99%, there's a 0% deliberately kept put there just for illustration and so on. So there are 12 numbers like this. So if I want to calculate the growth of, let's say I start investing 100 rupees. So I invest 100 rupees, and after 1 month, that 100 rupees would be 100 into 1 plus 2.07%. This next month it would be that into 1 plus 2.03%, the second month's return, and so on and so on and so on. But I'll get some money at the end of 1 year. So in order to equate the annual return, that is the annual growth, that I'll call this annual growth as 1 plus CAGR, I can just call it 1 plus return. That 1 plus return, the annualized return, or the annual return in this case, because it's just 1 year, that 1 plus CAGR is equal to the product of those returns. So 1 plus 2.07% into 1 plus 2.03% into 12 terms like that. So if I equate these and if I compute the CAGR from this, I will get 26.24%. So this is how I calculate an annual return from a set of monthly returns. I call it the CAGR, but it's essentially the annual return here. So now suppose I take a fund and I take a benchmark and I list the monthly returns over any given period. It can be 1 year, 3 years, however you want, and I compute and I list the fund's monthly return and the index or the benchmark index monthly return, and then I sort. And I just list only those months when the benchmark index was greater than 0. So whenever the benchmark index was greater than 0, I have an entry here. Otherwise, if the benchmark index is negative, this is just left blank. Now, for those months when the benchmark index was greater than 0, I list the fund's returns. So if you notice here, in the first month, the benchmark index return was 2.07%. The fund managed to give a monthly return of 3.43%. But the next month, the index gave 2.03%, but the fund managed only minus 0.4%. So now that I have these two listed, I calculate what is known as the upside CAGR. Just like in the previous slide where I showed you how to calculate the annual return, I calculate the CAGR out of these months when the index return was greater than 0, and that value is 26.24%, let's say. And then I do the same thing for the corresponding fund returns, and that value is 5.97%. Now I define my upside capture ratio as the upside CAGR of the fund divided by the upside CAGR of the index. So 5.9% of the fund divided by 26.24% of the index, and that gives me 22.48%. That's called the upside capture ratio. This means that the fund has only captured 22.4% of the index gains. That is whenever the index moved up. And that's essentially how the upside capture ratio is calculated. I have a video called How Mutual Funds Manage to Beat the Benchmark, and in that I would have shown you how upside capture is really not relevant over the long term. It's only the downside capture, the exact opposite of this, which results in alpha generation. If you want, you can go have a look at that video. Now we do the exact opposite for calculating the downside capture. So now I list all those months when the index returns were negative. Then I list the corresponding month, the fund returns for those months when the index return was negative. I calculate the downside CAGR of the fund, that is minus 8.9%. I calculate the downside I calculate the downside CAGR of the index, that's minus 8.9%. I then calculate the downside CAGR of the fund, which is minus 1.2%. Then I compute the downside capture ratio as minus 1.23% divided by minus 8.94%, and that's 13.7%. This means that the fund has only captured 13% of the index losses, and that's a good fund. So you want the downside capture to be less than 100%, less than anything less than 100% means that the fund has managed to capture less than the full benchmark losses, and upside capture should ideally be greater than 100%. That means the fund has gained more than the benchmark gains. But you won't get both of them. Typically, if you notice, a fund which tries to do well when the benchmark does well, that is a fund which has got an upside capture of greater than 1 or greater than 100%, typically does not have a good downside capture of less than 100% or less than 1. So, but it's more easier to find funds with less than 1 downside capture. And what I do in my fund screener is I calculate the downside capture ratio for every possible 1 year period, 2 year period, 3 year period, 4 year period, 5 year period from the last business date when I publish the screener to January 1st, 2013 for direct plans. So in these, out of these, let's say I have 100 downside capture data for a particular duration, let's say 1 year. Out of those 100 downside capture data points, I find out how many data points had a downside capture ratio of less than 100%. That's a good downside capture. And so that many, so number of data points with the downside capture less than 1 divided by total number of data points gives me my downside protection consistency. And this is what is used in the fund screeners. So please let me know if you have any questions. If you want any more such tutorials, please let me know. I'm always looking out for good ideas. I'll be happy to do that. Bye-bye.